इतना डाउन।
Namaskar and greetings to all in this month of Raksha Bandhan, Independence Day, Janmashtami, Parsi New Year, and Ganesh Chaturthi. May this pious and auspicious month bring good luck to all of us and to our economy. The monsoon season has been progressing well. We are also approaching the festival season, which typically brings greater enthusiasm and buoyancy in the economic activity. This favorable setting, together with supportive policies of the government and the Reserve Bank, augurs well for the Indian economy in the near term, as geopolitical uncertainties have somewhat abated, even though global trade challenges continue to linger. Over the medium term also, the Indian economy holds bright prospects in the changing world order, drawing on its inherent strength, robust fundamentals, and comfortable buffers. Opportunities are there for the taking, and we are all making efforts to create enabling conditions through a multi-pronged yet cohesive approach to policy making. Globally, policymakers are faced with muted growth and slowing pace of inflation, with some advanced economies even witnessing an uptick in inflation. As the dust settles and a new equilibrium emerges in the new global order, policymakers will have a tough task navigating a world characterized by modest growth, sticky inflation, and elevated public debt levels. At the Reserve Bank, leveraging on the room provided by a significant moderation in inflation, we have taken decisive and forward-looking measures to support growth. The coordinated use of various tools available to us has helped accelerate monetary policy transmission in the current easing cycle. The Monetary Policy Committee, MPC, met on the 4th, 5th, and 6th of August to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the Liquidity Adjustment Facility, LAF, unchanged at 5.5%. Consequently, the standing deposit facility rate shall remain unchanged at 5.25%, and the marginal standing facility rate and the bank rate at 5.75%. The MPC also decided to continue with the neutral stance. The MPC noted that while headline inflation is much lower than projected earlier, it is mainly due to volatile food prices, especially in vegetables. Core inflation, on the other hand, has remained steady around the 4% mark as anticipated. Inflation is projected to go up from the last quarter of this financial year. Growth is robust and as per earlier projections, though of course below our aspirations. The uncertainties of tariffs are still evolving. Monetary policy transmission is continuing. The impact of the 100 basis points rate cut since February 2025 on the broader economy is still unfolding. On balance, therefore, the current macroeconomic conditions, outlook, and the uncertainties call for continuation of the policy repo rate of 5.5% and wait for further transmission of the front-loaded rate cut to the credit markets and to the broader economy. Accordingly, the MPC unanimously voted to keep the repo rate unchanged. The MPC further resolved to maintain a close vigil on the incoming data and the evolving domestic growth inflation dynamics to chart out the appropriate monetary policy path. Accordingly, all members decided to continue with the neutral stance. Now I'll turn to an assessment of the growth and inflation in our country. First of all, growth. Domestic growth is holding up and is broadly evolving along the lines of our assessment, even though some high-frequency indicators showed mixed signals in May, June this year. Rural consumption remains resilient, while urban consumption revival, especially discretionary spending, is tepid. Fixed investment, supported by buoyant government capex, continues to support economic activity. On the supply side, steady southwest monsoon is supporting kharif sowing, replenishing reservoir levels, and boosting agriculture activity. Moreover, services activity remains steady, though some high-frequency indicators recorded a modest expansion. Services PMI increased to an 11-month high of 60.5 in July 2025. Construction activity continues to exhibit resilience. However, growth in the industrial sector remained subdued and uneven across segments, pulled down by electricity and mining. While the manufacturing PMI remained elevated in Q1, the IIP, Index of Industrial Production, showed moderation. Turning now to the growth outlook, the above normal southwest monsoon, lower inflation, rising capacity utilization, and congenial financial conditions continue to support domestic activity. The supportive monetary, regulatory, and fiscal policies, including robust government capital expenditure, should also boost demand. With sustained growth in construction and trade segments, the services sector is expected to remain buoyant in the coming months. Prospects of external demand, however, remain uncertain amidst ongoing tariff announcements and trade negotiations. The headwinds emanating from prolonged geopolitical tensions, though abated as I mentioned earlier, persisting global uncertainties, and volatility in global financial markets pose risks to the growth outlook. Taking all these factors into account, real GDP growth for 2025-26, the current year, is projected at 6.5%, our earlier projection, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. Real GDP growth for Q1 next year, 2026-27, is projected at 6.6%. The risks are evenly balanced. I will now speak on the domestic inflation. CPI headline inflation declined for the 8th consecutive month to a 77-month low of 2.1% in June. This was driven primarily by a sharp decline in food inflation, led by improved agricultural activity and various supply-side measures. Food inflation recorded its first negative print since February 2019. It was negative 0.2% in June. Double-digit deflation in vegetables and pulses drove this contraction. High-frequency price indicators signal a continuation of the lower price momentum in fruit prices to July, the last month as well. Fuel group inflation moderated over 2 successive months to record 2.6% in June. Core inflation, on the other hand, which remained within a narrow range of 4.1 to 4.2% during February to May this year, increased slightly to 4.4% in June, partly driven by continued increase in gold prices. The inflation outlook for 2025-26 has become more benign than expected in June. large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains have contributed to this moderation. CPI inflation, however, is likely to edge up above 4% in Q4 of this year and beyond, as unfavorable base effects and demand-side factors from policy actions that we took a little while ago, a few months ago, come into play. Barring any major negative shock to input prices, core inflation is likely to remain moderately above 4% during the year. Weather-related shocks pose risks to inflation outlook. Considering all these factors, CPI inflation for the current year 2025-26 is now projected at 3.1%. This is down from 3.7% that we had earlier projected in June, with Q2 at 2.1%, Q3 at 3.1%, and Q4 at 4.4%. CPI inflation for Q1 next year, 2026-27, is projected at 4.9%. The risks are evenly balanced. I will now be speaking about the external sector. India's current account deficit CAD moderated to 0.6% of GDP last year in 2024-25 from 0.7% of GDP in 2023-24. And I want to underline over here that it is not only in percentage terms as a proportion of GDP that it decreased by about 0.1% because of the expansion in GDP, but also because of a decrease in absolute terms of CAD by about $3 billion US dollars from $26 billion to $23 billion. And this is on account of robust services exports and strong remittances receipts. Despite a higher merchandise trade deficit, we have been recording, as you are aware, a high growth rate of about 17% in services exports in the last 4 years, and about 14% compounded annual growth rate of remittance receipts in the last 4 years ending 2024-25. This has made up more than for the higher merchandise trade deficit that we had last year. The merchandise trade deficit further widened in Q1 of 25-26. India's share in world services exports has risen markedly from about 2% in 2005 to 4.3% in 2024, driven by strong software and business services exports. Robust services exports coupled with strong remittance receipts are expected to keep the CAD within sustainable level even during the current financial year. On the external financing side, gross FDI to India remained strong during April to May 2025-26 this year. However, net FDI moderated during this period due to higher outward FDI. FPI inflows to emerging markets and economies have remained strong in May and June 2025. However, net FPI to India recorded outflows of 0.8 billion US dollars this year so far till July 31. This is mostly on account of outflows in the debt segment. External commercial borrowings, on the other hand, witnessed higher net inflows compared to that last year. Inflows under non-resident deposits too remained positive, albeit witnessing some moderation. As on 1st August 2025, India's foreign exchange reserves stood at a robust $688.9 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to remain resilient. We remain confident of meeting our external financial requirements comfortably. I will now turn to liquidity and financial market conditions. System liquidity as measured by the net position under the liquidity adjustment facility has been in surplus on an average of about 3 lakh crore rupees per day since the last MPC. This is in comparison to an average daily surplus of 1.6 lakh crore rupees during the previous 2 months. Going ahead, as the CRR cut announced in last policy comes into effect in a staggered manner beginning September, it would further support liquidity conditions. The comfortable liquidity in the banking system has reinforced transmission of the policy repo rate cuts to the money, bond, and credit markets during the current easing cycle. In the credit market, the weighted average lending rate of scheduled commercial banks declined by 71 basis points as against the 100 basis points rate cuts for fresh rupee loans, and of this 55 basis points is due to interest rate reduction, the remaining on account of the change in the mix of the loans. Further, on outstanding rupee loans since February 2025 to June 2025, there has been a 39 basis points reduction in the weighted average lending rate. On the deposit side, similarly, the weighted average domestic term deposit rate on fresh deposits moderated by 87 basis points during the same period. Moreover, the transmission to lending rates has been broad-based across all sectors. Going ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management. We will endeavor to maintain a sufficient liquidity in the banking system so that the productive requirements of the economy are met and transmission to money markets and the credit markets remains smooth. Here I would like to take a moment and mention, while we are on this subject of liquidity, that an internal working group, as some of you may be aware, had been set up by the Reserve Bank to review our extant liquidity management framework, which has been in operation since February 2020. It had been 5 years. So this working group was set up. It has submitted its report, and we will be shortly publishing the same on our RBI website for public consultation. The group broadly has found that the WACR, the weighted average call rate, is highly correlated with the other money market rates, with TREPs and market repo in the collateralized segments. Further, they have also found that it is effective in transmitting signals to other money market instruments across maturities. Therefore, the group has recommended continuation of the overnight WACR as the operating target of monetary policy. The group has inter alia also recommended to continue with the variable repo and reverse repo rate auction mechanisms of various tenors with the objective of maintaining the operating target rate at the policy rate. I will now come to financial stability. The system level financial parameters relating to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain very healthy. The CRAR is more than 17%, NIM at 3.5%, the liquidity at 132%, the GNPA at about 2.2%, NNPA at about 0.5 to 0.6%. The credit deposit ratio for the banking system is at 78.9%, broadly similar to that a year ago. Similarly, the system level parameters of NBFCs too are sound, with adequate capital position and improved gross NPA ratios. Bank credit grew at 12.1% last year in 2024-25. And I want to highlight over here that while it was slower than the growth rate of 16.3% in 23-24, it is higher than the average growth rate of 10.3% recorded in the 10-year period preceding 24-25. Moreover, it is important to look at all sources of funding to the non-financial sector and not only bank credit. And so we find that in 24-25, while the bank credit, non-food bank credit in fact, reduced by about 3.4 lakh crore rupees from 21.4 lakh crore to almost 18 lakh crore, the flow from non-bank sources more than made up for this decrease. Thus, even though growth rate of bank credit slowed last year, the overall flow of financial resources to the economy increased from 33.9 lakh crore rupees in 23-24 to 34.8 lakh crore rupees last year. That is an increase of almost a lakh crore of rupees. And we find that this trend continues even during the current financial year. As transmission to money markets has been faster, large corporates increasingly have relied on market-based instruments such as commercial paper and corporate bonds to source funds, reducing their exclusive reliance on bank credit. Similarly, profitability of large corporates has increased. Their internal resources, therefore, have become an important source for business expansion. Before I conclude, let me underline that for us at RBI, the interest and welfare of citizens of India is foremost. It is the people of India, including those at the very bottom of the pyramid, who are our raison d'etre, the reason of our being. In this regard, therefore, I have three consumer-centric announcements to make. One, as Jan Dhan scheme launched about 10 years ago, completes now the decade. A large number of accounts have therefore become due for re-KYC. The banks are therefore organizing camps at Panchayat level from 1st of July to 30th of September in an endeavor to provide services at consumer doorsteps. Apart from opening new bank accounts and re-KYC, the camps will also focus on microinsurance and pension schemes for financial inclusion and customer grievance redress. Two, we will be standardizing the procedure for settlement of claims in respect of bank accounts and articles kept in safe custody, or in other words, safe deposit lockers of deceased bank customers. This is expected to make settlement of such claims more convenient and simpler. Three, we are expanding the functionality in RBI Retail Direct platform to enable retail investors to invest in treasury bills through systematic investment plans. I now make my concluding remarks. Despite a challenging external environment, the Indian economy is navigating a steady growth path with price stability. Monetary policy has appropriately used the policy space created by the benign inflation outlook to support growth without compromising on the primary objective of price stability. Transmission of our recent policy actions to the broader economy is underway. As the Indian economy strives to attain its rightful place in the global economy, a stronger policy framework across domains, and not just limited to monetary policy, will be pivotal in its journey. We, on our part, will continue to be agile and proactive in maintaining and providing a facilitative monetary policy, which will be based on incoming data and the evolution of the growth inflation dynamics. As always, we will have a clear, consistent and credible communication backed by actions necessary for the task at hand. Thank you, Namaskar and Jai Hind.
Okay,